Ladies and gentlemen, it's not very often that you publish a detailed video on the state of the US economy and US labor market, and then around the same time, no less than the chairman of the Federal Reserve comes in front of cameras from around the world and starts commenting on exactly the same things that you have discussed in your video. It's rarer still if the views articulated by the Federal Reserve chairman ends up being diametrically opposite to the views expressed by you in your own video. But guess what? The real fun begins when the narrative of the Federal Reserve chairman starts to unravel and it's your own views which ultimately prevails. Ladies and gentlemen, bizarre as it may sound, this is precisely what has transpired over the last 1 week or so. In this video, I'm going to talk about this epic debate and what are the implications of this debate for your investments. Ladies and gentlemen, hi. It's not very often that you get to spar with no less than the chairman of the Federal Reserve on the state of the US economy and the labor market. And who finally won this duel, you would ask? Well, I'm going to let you decide. But before that, some context. Ladies and gentlemen, I published my last video on 1st of August 2025. And in this video, I argued that the US economy is looking increasingly shaky, especially if you look at the state of the US economy through the lens of the US labor market. And that's because, as I argued in this video, the US labor market is not just in a very bad shape right now, it's getting worse still by the day. My dear friends, as luck would have it, I ended up recording this video just 1 day after Federal Reserve concluded its most recent meeting of the FOMC, the Fed Open Market Committee, on 30th of July 2025, at the end of which the Fed, in its wisdom, decided not to cut the Fed funds rate and instead hold rates steady. And as is customary, after the FOMC meet, Federal Reserve Chairman Jerome Powell held a press conference and provided a detailed assessment from his side on the state of the US economy and the labor market. And what was his assessment? Well, take a listen for yourself.
The labor market data we still think is, continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages, still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid.
The labor market is still quite solid. There you heard it, my friends, from the horse's mouth. And that's why, my dear friends, as soon as my last video came out on 1st of August 2025, many of my viewers were very quick to point out that what I was trying to argue in my video was almost the polar opposite of what Jerome Powell was trying to argue in his press conference with respect to the state of the US economy and especially with respect to the state of the US labor market. What exactly is it that I had argued about the US labor market in my last video? Let's listen in. Starting June of 2025, the most important data release related to the US labor market that we got was on 6th of June 2025, which is when we got the release of the US non-farm payroll report. Now, this was the payroll report for the month of May of 2025, and according to this report, the US economy added 139,000 new jobs in the month of May of 2025. Now, the initial reaction of most market commentators to this payroll report was in fact quite positive. Most market commentators interpreted the creation of 139,000 new jobs in the month of May 2025 to mean that the US labor market was in fact quite strong rather than weak. But the reason behind this positive interpretation was quite bizarre. And the reason was that the consensus expectation before the release of this payroll report was just 125,000 new jobs. And against that, we got 139,000 new jobs. But my dear friends, in order to truly understand whether the US labor market is moving towards strengthening or weakening, we need to look at these 139,000 new jobs created in the month of May 2025 in the backdrop of how new job creation has been shaping up right through 2025. And when you do that, the figure of 139,000 new jobs for the month of May 2025 doesn't look strong at all. Because as you can see here in this data, month on month, new job creation peaked pretty much in March of 2025. And since then, number of monthly new job creation has been sliding down. Not just that, as you can see in this chart, at 139,000 new jobs, May of 2025 has been the weakest month in 2025 so far in terms of new job creation. Not just that, the picture becomes scarier still once you look at the revisions that are made to these monthly numbers by the Bureau of Labor Statistics subsequently. So what are these revisions that I'm talking about? Well, as you can imagine, not every survey respondent who is surveyed by the Bureau of Labor Statistics is able to send in their response before the monthly report is published by the Bureau of Labor Statistics. The survey responses continue to pour in even after the initial monthly report has been published. And in the light of these new responses that keep coming in, the Bureau of Labor Statistics also keeps on updating its initial numbers. Also, there are adjustments done to this data by the Bureau of Labor Statistics to account for month-on-month seasonality. As you can see here, there were significant downward revisions that were done to pretty much every single month's data of 2025. January numbers were revised down from 143,000 to 125,000. February numbers were revised down from 151,000 to 117,000. March numbers were revised down from 228,000 to 185,000. And finally, April numbers were revised down from 177,000 to 147,000. So if you look at the aggregate picture between January and April of 2025, as per the initial data release, new job creation between Jan and April of 2025 was pegged at 699,000 new jobs. Finally, this number was revised down to 574,000 new jobs, which effectively meant that 125,000 new jobs were simply wiped out as part of these revisions. That's a downward revision of nearly 20%. Ladies and gentlemen, such strong downward revisions, that too happening consistently month on month, is one of the strongest signs that the US labor market is in fact weakening, not strengthening. Now coming to the payroll report for the month of May 2025, would you still call 139,000 new jobs created in the month of May of 2025 a sign of a strong labor market? Ladies and gentlemen, mind you, we are talking about 139,000 new jobs for the month of May, which makes for the lowest print of 2025 before revisions have kicked in. Just imagine what this number is likely to go down to once the revisions come in. So those were my views about the US labor market. And quite clearly, my and Powell's views about the US labor market could not have been more far apart than this. You must be wondering who won this debate. Well, thankfully, we didn't have to wait too long for this debate to be settled conclusively. And that's because on 1st of August 2025 itself, within a couple of hours of my last video going live, the US Bureau of Labor Statistics, that is USBLS, released the non-farm payroll report for the month of July 2025. And boy, the numbers weren't just bad. The monthly report pretty much signaled a collapse in new job creation. Remember this slide? Well, as per the monthly non-farm payroll report for the month of May 2025, the US economy was supposed to have created as many as 139,000 new jobs, and this was prior to revisions. We now have the numbers post-revision for the month of May 2025. And guess by how much this figure of 139,000 came down by post-revision for the month of May 2025. Before I show you the revised numbers, let me move the content a little bit to the left to make some space. Now time for the revised numbers. The BLS has revised the May numbers down to just 19,000. That's the number of new jobs that were actually created for the month of May 2025. And the bad news doesn't end there. For the month of June 2025, as per the original non-farm payroll report, BLS's estimate was that the US economy had created as many as 147,000 new jobs. Post-revision, this has now come down to just 14,000. My dear friends, this effectively means that between May and June of 2025, as per BLS's original estimate, the US economy was supposed to have created as many as 286,000 new jobs. Post-revision, this has now come down to just 33,000. That's a downward revision of almost 90%. My dear friends, so much so for Powell's assertion that the US labor market is still quite solid. No wonder we haven't heard from Powell or any of the Fed governors who voted to hold rates steady in the last FOMC meet since the July non-farm payroll report was released. And the last piece of data that we have with us right now is the number of new jobs created by the US economy for the month of July 2025. At 73,000, the number of new jobs created in the month of July 2025 is already the lowest for any month in 2025. But the scarier part is nobody thinks that it's going to be 73,000 ultimately. Given the scale of revisions that we have seen in recent months, everybody is now wondering what this 73,000 is going to ultimately come down to once revisions come in. Could this 73,000 actually come down to something like 7,000? Or still worse, could we actually end up getting net job losses for the month of July 2025? And what could be the implications for these really bad payroll numbers for Fed funds rate? Could we finally see the Federal Reserve resume rate cuts from its next meeting in September of 2025? Well, this is something that I had clearly and unambiguously predicted in my last video that was published on 1st of August 2025. Let's listen in. And that's why, ladies and gentlemen, I believe that by the time the Fed meets the next time in September of 2025, it will be impossible for the FOMC to ignore the worsening state of the US labor market and the overall state of the US economy and push off rate cut decisions any further. So this is what I predicted about rate cuts in my last video that was published on 1st of August 2025. But thankfully, we do not have to wait till September to know whether I'm going to get this right, because we have something called CME Fed Watch. And what is CME Fed Watch? Well, CME Fed Watch basically keeps track of how bond market traders are betting in the futures and option market with regards to where they see Fed funds rate around the next time the Federal Reserve meets. And accordingly, the CME Fed Watch actually comes up with an estimated probability of how likely is the Federal Reserve to cut rates or hike rates or keep rates steady at the end of the next FOMC meet. And this probability keeps on changing every day based on how bond market traders are betting in futures and option market. But the most important reason why these probabilities published by the CME Fed Watch matter is because historically, the CME Fed Watch has had one of the best track records possible with respect to predicting the next move of the Federal Reserve in the run-up to upcoming FOMC meets. Now, up until one day before the release of the July non-farm payroll report, the CME Fed Watch was ascribing a probability of only 41% to the possibility of Fed cutting Fed funds rate in its next meeting that is scheduled for September of 2025. That was a very, very low probability, because 41% is lower than even the probability of getting a toss of a coin right. But everything has changed since the release of the July non-farm payroll report. Since then, the probability of a rate cut by the Fed in its September meet has gone up to as high as 91%. My dear friends, it's pretty much now a given that the Fed is going to cut rates in September. And what are the implications of the Fed resuming rate cuts for the broader economy and for equity markets? Well, these grim payroll numbers and the Fed having to resume rate cuts in response to that can mean only one thing. And that is the US economy is on an unmistakable path towards slowing down, if not on a path to an outright recession. And if history is anything to go by, then a possible recession in the near future in the US can mean only bad things, not just for the US economy and US equity markets, but for equity markets around the world, including here in India. For example, we got a very severe recession in the US from January 2008 onwards. This was, of course, in the aftermath of the global financial crisis of 2007-2008. This recession, in turn, led to a brutal 60% correction in the Nifty here in India. The next time we got a recession in the US was in January of 2020 because of the onset of the COVID pandemic. And once again, this recession in the US led to a brutal 38% correction in the Nifty here in India. But my dear friends, what gets invariably overlooked, and this is something that I have repeated ad nauseum in so many of my previous videos, is that before these large stock market drawdowns play out because of the onset of a recession in the US, we invariably get this one last melt-up rally in equity markets in the run-up to the onset of a recession in the US. And historically, we have got this one last melt up whenever the Fed has started to cut Fed funds rate in order to provide support to a weak economy in the run up to a recession. And that is because as soon as the Fed starts to cut Fed funds rate, that leads to a dramatic improvement in liquidity conditions for financial markets. For example, before the recession of 2008, which started from January 2008 onwards, we had the Fed starting to cut Fed funds rate 4 months before the start of the recession. That is from September 2007 onwards. And as soon as the Fed started to cut Fed funds rate, that kick-started a furious rally in the Nifty that went on for next 4 months, all the way till January of 2008. And during these 4 months, the Nifty rallied by a staggering 38%. Similarly, before the onset of the recession of 2020, which was caused by the onset of the COVID pandemic, the Fed had in fact started to cut Fed funds rate from August of 2019 itself. And that in turn kickstarted a rally in the Nifty that went on for next 5 months, all the way till January of 2020, which is when we finally got the onset of a recession in the US because of the onset of the COVID pandemic. And in these 5 months between August of 2019 and January of 2020, the Nifty managed to rally by 13%. And that's why, ladies and gentlemen, I'm so looking forward to the resumption of rate cuts by the Federal Reserve. Because if history is anything to go by, then resumption of rate cuts by the Federal Reserve will ultimately pave the way for the onset of a recession in the US. And the onset of a recession in the US will very likely cause a very large stock market correction, not just in the US, but everywhere around the world, including here in India. But history also tells us that before we get the next big crash accompanying the next recession in the US, we'll also very likely witness a large melt up in equity markets in the run up to the onset of the next recession in the US. Clearly, ladies and gentlemen, this is not the time to be pessimistic. One more thing you have to be careful about at this stage, my dear friends, is how the dominant narrative is going to change from here. So far, the dominant narrative has been one of extreme exuberance, especially since hostilities came to an end between Iran and Israel with the announcement of a ceasefire on 25th of June. Post that, what added to the positive sentiment was a bunch of quick trade deals that Donald Trump and his administration managed to arrive at with key trading partners of the US, such as Japan and the European Union. And equity markets cheered these positive developments by way of very, very strong rallies. And it was starting to look like as if we are now at the cusp of a multi-year bull run. But I'm going to warn you, my dear friends, that after the release of the July payroll report, this narrative is going to change very, very rapidly. And the narrative that is likely to emerge from here is likely to be one of doom and gloom of an upcoming recession. And that's why, my dear friends, you have to be very, very careful so as to ensure that your investment decisions at this stage are not guided by these negative sentiments linked to recessionary headlines that you're going to repeatedly get from now onwards. Because if you do get carried away by this gloom and doom narrative, then you will very likely miss out on this one last melt up that very likely lies ahead in the near future. Instead, what you have to ensure at this stage is that your investment decisions are nothing but data driven. And I'm not even suggesting that this melt up is likely to be a one-way ride up. Instead, as I have stressed in many of my previous videos, including as recently as my last video that was published on 1st of August, during the course of this melt up, we are likely to see multiple interim pullbacks in equity markets. But my dear friends, as I explained in my last video, if you manage to keep your emotions aside and commit to being data dependent at this stage, then you stand a very good chance of not just riding this upcoming melt up in equity markets, but also being able to sidestep the interim pullbacks that you're likely to get during the course of this melt up over the next couple of weeks and months. And if you're looking for pointers on how to adopt a data-driven approach so as to navigate the twists and turns of the equity markets at this stage, then I'll highly encourage you to go and have a look at this earlier video of mine, which I had published on 12th of April 2025. In this video, I have discussed two key global macro parameters, US junk bond spreads and the MOVE index. We have found these two parameters to be highly effective at this stage of the business cycle, especially when it comes to detecting the onset of interim pullbacks in the Nifty during the course of a melt up. If you haven't had a chance to go through this video, then I'll highly encourage you to go through this video. I'm going to leave a link to this video in the description of this video. And if you are one of those who does not have the time to keep track of these global macro parameters and would need external help with respect to managing your investment portfolio, then you can consider investing in our flagship AlphaSIP Strategy. In the AlphaSIP Strategy, we continuously rebalance our client portfolio based on not one, not two, not three, but more than 15 global macro parameters. And our rules-based approach has helped us execute a bunch of fantastic trades, which in turn have helped our clients sidestep the correction that has been witnessed in the Nifty since September of 2024. We offer the AlphaSIP Strategy in 3 different variants, the details of which are there on your screen right now. And the variant which is most popular with retail investors is the AlphaSIP tax saver variant, in which, as long as your investment amount is within 2.5 lakh rupees per year, the entire maturity proceeds can potentially be tax-free under Section 1010D. If you're interested in any of the three variants of the AlphaSIP strategy, then you can go to our website metacaps.ai/products and register for the variant that suits your requirement the best. And somebody from our sales team will get back to you to take the discussion forward. Ladies and gentlemen, that's it for now. This brings me to the end of this video. I sincerely hope that you like the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel. Thank you for watching this video, and goodbye till we meet again in the next video.